Welcome to the Protect, putting a floor, and Advance strategy. Before we go into the mechanics, let's set the stage. Let's give a little context. This is the S&P 500. You had the run up in the 90s. We had the 001 correction. You run up in the mid 2000s. We have the 2008 correction, S&P down 37%. Then it takes you 4 years to get back to even. Then 2013, a big year, almost 30%, and everybody's sitting up here and everybody's feeling good. In equities, you buy low, sell high. Most people went through the pain of 08. That's the whole point of protectmyretirement.today. We're trying to help people not repeat the mistakes that occurred in 2008. And we have plenty of other videos that talk about that. The context I want to discuss that is germane to the Protect and Advance program is, if this is you, you've run up here, you're at this high point, you want to move to something safe, you want to secure your advance. How do you do that? Well, most people move to bonds. That's a problem. And this picture tells you why it's a problem in two respects. First, this is the 10-year Treasury. Here we are mid-year 2014. The 10-year Treasury is trading about 2.6%. And it's obvious. You're simply not getting paid to have your money in a safe place. Whether you're buying treasuries or buying corporate bonds, or if you're even going to the bank, you're not even getting 1% for a CD. So if you want to move money out of equities into safety, you're not being paid for it, number one. Number two, look at the norm. This goes back all the way to the 1960s. The norm is in this 3 to 7% range. That is normal. I don't know when interest rates are going to go up. The Fed has been keeping things down. They say they're going to start releasing the interest rates in the third quarter 2015. I don't know if the market moves before that or not. Heck, we could end up being like Japan and be flat for 10 years. I don't know. The one thing I do know is this. If this is my portfolio, today, most people, depending on your age and your goals, you have more equities than you do bonds. Why? Like we just said, you're not being paid to be in bonds. The only pull-through on returns is on the equity side. But we have this problem that after 08, we went here, and now we're sitting up at this high point up here. So we can't run to safety because we're not getting paid for it, number one. I said there was two reasons. So number one, we're not being paid for it. But the second reason is it's inherently dangerous. Why? Because of this graph right here. Interest rates go up, bond values go down. It is a law of investing. Just like you want to buy low and sell high, if you're in bonds, interest rates go up, you will experience pain if you're holding bonds. So what do we do? What is our strategy? Our strategy in 2014 is very specific. It's the Protect and Advance program. So let me just walk you through that. What we do is we use an insurance company. Why an insurance company? Because insurance companies are excellent at managing what? They are excellent at managing risk. That's what they're in the business to do. Whether you are paying premiums for your homeowner insurance, your health, your life, whatever it is, their job is to manage that risk. So we're going to go to an insurance company with our money, and we're going to have them pay us an interest credit. Why do we do this? Well, we want to put a floor underneath our retirement dollar. So whatever the dollar amount is that you put in, there's a floor. It cannot go below that. We are not going to be putting the money in the market. Instead, we are going to be buying an option on the market, for instance, the S&P 500. So this interest credit is what buys the option for us. Our money is not in the market. Our money is in a safe portfolio earning an interest credit. We take the interest credit, we buy an option on the S&P 500. Why is that important? Well, the way these programs work, when you go and buy an option, you're only going to get so much of the upside on the option. It's too detailed to explain in this video, but we have other videos that explain how this pricing dynamic works. But in a program like this, we are going to have some kind of cap or some kind of spread that determines how much of the upside of the market we're going to get. The programs we like, we're going to get somewhere in the 2.4 to 3.5% range. Meaning, we'll just use a middle number here. We'll say 3. Meaning if the market goes up 13, we're not going to get 13, but we're going to get 10. So you put your money in, there's a floor, it cannot go down. The money's not going in the market, we're buying an option in the market. Let's say the first year the return is 13. Do we get 13? No, we don't get 13, we get 10. So now we have 10. So whatever we have up here, our money's grown by that 10%. That is our new floor. We cannot go below that. The next year, the market goes up 7. Do we get 7? No, we get 4. So then we're up to here at 4. That's our new floor. We cannot go below that. Then the market, sure enough, there's a correction. The market goes down 20. What happens in every other portfolio? What happens if you're up here? What happens to this section of your portfolio right here if the market goes down 20? You are going down 20 plus. Why do I say plus? Because if you're in any kind of fund or money management program, you're being charged fees. So if you're in a fund that's charging 1% and you have a 1% fee, you're going to be charged 2%. So now you're down 22, not just 20. What happens in our Protect and Advance program? Well, this is where the Protect comes in. As you can see, we already advanced when the market went up. Now it's Protect. For this period, this 1 year period, we move sideways. Why? Because our money's not in the market. We had an option. These are all 1 year options. We let the option expire. We move sideways. Then what happens? In the 4th year, markets rebound. They always do. So let's say the market rebounds 10%. Do we get 10? No, we get 7. Everybody else that's not in the Protect Advance program starts from this point here. Remember, they went down. They went down. They're starting 7 from here. What about you in the Protect and Advance? You start from here. You go up 7 from here. That's your new floor. As you can see, we advance, we protect, we advance. Why? Because we have an interest credit from an insurance company. We are buying an option. Our money is not in the market. When the market performs, we participate. When the market does not, we move sideways. If you want to learn how this program can work for you, go to the contact button on the website. Click on that, enter your information. We'll set up a go-to meeting, a webinar where you're sitting in front of your computer. We're sitting in front of ours. We talk on the phone. And just like you see this whiteboard here, we'll walk through your particular situation so you understand it. You can ask questions, and we just go back and forth. Now is the time. We are sitting at this point right here. We are sitting at this point. I'm not trying to say that the market's going to go crashing today. What I am suggesting for you to do is watch the other videos on protectmyretirement.today and look at all the data and all the resources we put in to help you explain why it makes sense today to put a floor underneath your gains. So if and when the market goes down, you do not go down. But the good news is you will participate according to whatever strategy we use in this area right here. You will participate on the upside. Thanks for watching and hope to hear from you.